The next problem, as I told you, is a very important problem. Under buyback, the paper setter may be tempted to ask this question. Why this question is important? Let's read the problem. Perot, a non-listed company, has the following capital structure on 31/3/2020. Equity capital, shares of 10 each, fully paid 330 crores. Reserve surplus, general reserve, premium, P&L, infrastructure, development reserve. Loan fund is 1800 crores. This is the capital structure of the company. Shareholders of the company, on the recommendation of the board of directors, have approved on 12th September 2020 a proposal to buy back the maximum permissible number of equity shares. How many shares they didn't tell you. Whatever is possible, that many shares should be bought back. For that, the shareholders have approved. Considering the large surplus available in the company, a lot of money is there. So what is the maximum permissible number of equity shares to be bought back? We have to calculate. That is based on our understanding of Companies Act. So in order to do this problem, we should be clear about section 68, subsection 1 and 2 of Companies Act. If a company would like to make a buyback of share, certain conditions have to be fulfilled according to those two sections. Based on that, you will have to calculate the number of shares to be bought back. That is why this problem is very, very important. What are the three conditions we have to comply? Remember, I told you in the earlier problem, according to Companies Act, the maximum permissible buyback is how much? Only 25% of the outstanding shares. But in that problem, they had bought back 3 lakh shares. It's not allowed. Is it not? Like that, one more condition. The maximum buyback cannot be more than 25% of the aggregate of paid up capital and free reserves. And finally, after buyback, the debt equity ratio should be 2 or more. It cannot be less than 2. So we have to check these 3 conditions and arrive at the number of shares to be bought back. In this problem, since they did not give you how many shares should be bought back, you have to apply the provisions of a Companies Act to calculate the number of shares to be bought back, and based on that, we have to make the journal entries. Okay? The prevailing market value of share is 25 per share. In order to induce existing holders to offer the shares for buyback, decided to offer a price of 20% over market price. That means the buyback offer is 30 rupees per share. 25 per share is a market price. But unless you give more than the market price, shareholders are not ready to take up the buyback. So the company offers them a buyback price of 30 per share. You're also informed that the infrastructure development reserve is created to satisfy income tax requirement. That means, in other words, that is not a free reserve. So general reserve is a free reserve, P&L is a free reserve, security premium is also a free reserve for the purpose of buyback, because we'll be buying back the equity shares at a premium. So when the shares are bought back at a premium, you'll be utilizing the balance in security premium. So therefore, for the purpose of buyback, even security premium will be regarded as a free reserve. What is the question? The question is to find the number of equity shares to be bought back. And based on that, you have to make the journal entries. So a clear understanding of section 68 is very, very essential in order to solve this problem. Maybe you would have done it elsewhere in a classroom, or you might find this in the study material or in some other books. But still, I thought it's an important question. So we are doing it in the rapid revision class. Okay. So friends, please note down this also in addition to the information given in the problem. According to the problem, the loan fund is 1800 crores only. But assume that the loan fund is 1500 crores or 1200 crores. What is the maximum permissible buyback? So actual loan fund is 1800 crores only. But if suppose the loan fund is 1500 crores or 1200 crores, what is the maximum permissible buyback? So case 1, case 2, case 3, like that you have to do this problem. So according to section 68 subsection 2 of the Companies Act, 3 tests are there to determine the maximum permissible buyback. The first test is share outstanding test. What does it say? The buyback of a company cannot be more than 25% of the shares outstanding. So now the company has 33 crores of shares outstanding. 25% of the above is only 8.25 crore shares. So according to the share outstanding test, the number of shares that can be bought back is 8.25 crore shares. So don't immediately jump into conclusion that this is the maximum permissible buyback. It is subject to the other test also. What is the other test? Resources test. Based on this, you can say 8.25, but that much of reserve should be available. That much of free reserve should be available in the company. So you should check the resources test also to determine how many shares can be bought back. What is resources test? Very simple. Find the aggregate of paid up capital and free reserves. So consider general reserve, P&L, security premium. Do not consider infrastructure development reserve because that is created to satisfy income tax requirements. So therefore, other than that, this is the total resource available. 750 crores is available. According to resource test, the buyback cannot be more than 25% of the total resources. What is 25% of above? 187.5 crores rupees. 187.5 crores. That means only this much money can be utilized for the purpose of buyback. The buyback price per share is 30. So the total amount that can be spent is 187.5 and buyback price is 30 rupees per share. How many shares can be bought back? It will be 187.5 divided by 30. That is 6.25 crore shares. So based on the share outstanding test, number of shares that can be bought back is 8.25. Whereas according to resource test, only 6.25 crore shares can be bought back. So which will you settle? 8.25 is not possible. We have to settle for 6.25. But can you say, okay, let us buy back 6.25 crore shares? No. One more test is there called debt equity test. Debt equity ratio test. According to the test, after buyback, the debt equity ratio should be 2 or more. It cannot be less than 2. So keeping that in mind, we have to find out how many shares can be bought back. Debt equity should be less than or equal to 2. It should not be more than 2, correct? After buyback, debt by equity, loan divided by equity here means what? Capital plus free reserves. That should be less than or equal to 2. It cannot be more than 2. Debt should be 2 times of the equity. Maximum. If debt is more than 2 times of equity, buyback cannot be made. Or you can make buyback to the extent when debt will be equal or less than 2 of equity. Now, in the problem, it is given the loan fund is 1800 crores. Debt is 1800. If debt is 1800, what should be the equity after buyback? So after buyback, it should not be more than 2 times of the total shareholders' funds. That means it should not be more than 1500 crores, but already it is 1800 crores. See, as of now, what is shareholders' funds? That is equity, capital plus reserves. As of now, the shareholders' fund is 750 crores, but it is 2.4 times. It should not be more than 2. So 1800 by 750 is 2.4. That means as of now, no buyback can happen. Why? Now the shareholder fund is 750 crores. Suppose you buy back, it will reduce. Debt equity will only increase. So if the loan fund is 1800 crores, no buyback is permissible. No buyback is permissible. Because already it is 2.4. If a buyback is done, it will further reduce the shareholders' funds. Debt equity will be more than 2. So as long as the loan fund is 1800 crores, no buyback is permissible. That means what? Based on the info given in the problem, the company cannot buy back anything. So therefore, what the company should do? The company should reduce the loan fund. So therefore, the problem tells you, suppose if loan fund is 1500 crores, what may be the buyback? 1200, what may be the buyback? Like that, they're asking you. Okay. So that means before buyback of share, the company should reduce the loan funds. by making payment to the lenders. Then only buyback can happen because lenders are outsiders. First discharge the outsiders, right? Then only you can pay off the equity shareholder. That is the objective. Shareholders cannot take the money and go out. Lenders have priority over repayment, right? Therefore, as long as the loan fund is 1800 crores, buyback cannot happen. Can it happen if the loan fund is 1500 crores? That is case 2. Suppose if loan fund is 1500 crores, can any buyback happen? Now, what is the shareholder fund as of now? 750 crores, which is exactly equal to 2, correct? So the debt equity as of now, if the loan fund is 1500, debt equity will be 2. That means if you make a further buyback, what will happen? It will reduce the shareholders' funds. Even in this case, debt equity will be more than 2. Therefore, even if loan fund is 1500 crores, no buyback is permissible. So, if the loan fund is 1800 crores, debt equity is 2.4, buyback will further reduce the shareholders fund. It will be more than 2.4. Buyback is not permissible. But if the loan fund is 1500, now the debt equity ratio is 2. But if you buy back the share, it will further reduce. So debt equity will be more than 2. So even in this case, no buyback is permissible. That means if the company really want to make a buyback, they should reduce the loan fund. That is why the problem tells you actual loan fund is 1800. What is a buyback? No buyback. Suppose 1500 crores. What is a buyback? No buyback. So at least let us take a situation if the buyback, if the loan fund is 1200 crores. If the loan fund is 1200 crores, whether buyback is possible? Yeah, it is possible, but only to some extent. So if the loan fund is 1200 crores, then after buyback, the shareholders fund, that is a capital plus free reserve, should be at least 600 crores. Then the debt equity ratio will be 2. It will be exactly 2 if the shareholders funds after buyback is 600 crores. Now it is 750. That means what? 150 crores can be utilized out of that for the purpose of buyback. So the present shareholder fund is 750, loan fund is 1200. After buyback, the shareholder fund should be at least 600. Then debt equity will be 2. So out of the 750 crores, 150 crores can be utilized for the purpose of buyback. So if the loan fund is 1200 crores, buyback is possible. But how many shares should be bought back? Immediately, what will you say? Sir, 150 crores is available. We can utilize that for the purpose of buyback. One share, 30 rupees. You are going to pay one share, 30 rupees. 150 crore is available. So divide and say, sir, 5 crore shares can be bought back. Like that, you may come to a conclusion, correct? But friends, please remember, when shares are bought back, out of the free reserve, an amount equal to the face value of shares bought back will be transferred to an account called capital redemption reserve. That means after buyback, a part of the reserve will become CRR, which is not a free reserve. Now there is an amount in the free reserve, but after buyback, what will happen? The free reserve will get converted into a CRR. That is not a free reserve. To what extent you will transfer from free reserve to CRR? It will be to the extent of the face value of shares bought back. What is the face value of shares bought back? 10 rupees. So if you buy back 5 crore share, 50 crores will be taken from free reserve to CRR. Then after buyback, that 50 crore cannot be considered as part of the shareholders' funds. So therefore, even though 150 crores can be utilized for the purpose of buyback, you cannot simply divide 150 by 30 and say 5 crore shares can be bought back. Then how to find out the answer? From now onwards only, the answer or this problem becomes more problematic. Up to this point, okay, you might have understood. Now, please look at this carefully, friends. Let us assume the nominal value of shares bought back be X, face value. This will be transferred to CRR, is it not? If you transfer this to CRR, it is not a free reserve. That means out of 150 crores, X has to be eliminated. That will be the actual free reserve after buyback. So, and assume the maximum permitted buyback to be Y. So since I do not know the buyback amount, I do not know the CRR amount, I do not know both, but this is related to that. Because if X is the face value of shares bought back, 3 times of that will be maximum permitted buyback. Correct, no? Face value 10 rupees, buyback is 30 rupees. The amount, nominal value of shares bought back will be taken to CRR. That will not be a free reserve. That means out of 150 crores, you have to eliminate X to find the maximum permitted buyback. Keep this as equation number 1. This has to be solved mathematically only. So 150 crore will be available after buyback. But out of that 150 crore, you will be transferring a certain amount to CRR. Once you transfer that to CRR, that is not a free reserve, therefore eliminate it. Only the balance can be utilized for buyback. So the maximum permitted buyback will be what? 150 minus X, that is allowed. What is Y is equal to? In other words, Y is nothing but 3 times of X. Y is equal to 3 times of X. Maximum permitted buyback is equal to what? Nominal value of shares bought back plus premium on buyback. What is that? That will be equation number 2. So y is equal to nominal value x, premium is 2x. If x is a nominal value, premium will be what? 2 times of that. Nominal value 10 rupees, premium 20 rupees, 2 times. So therefore, y is equal to x plus 2x. So y equal to 3x, equation number 2. So now friends, you got two equations with two variables. 150 minus x equal to y is equation number 1. Y equal to 3x is equation number 2. So if you solve these two equations, you get what is x, what is y. From this, we can easily find the number of shares to be bought back. I'm doing this very slowly because you might see this in your study material, but still you couldn't understand. Now, how to solve these two equations? So in equation 1, that is 150 minus x, you put y equal to 3x. So 150 minus x is 3x. Therefore, 150 is equal to 4x. X is equal to 37.5. Correct, Vijay Raghavan. Correct. What is x then? X is the nominal value of shares to be bought back, which will be transferred to CRR. So what will be y in that case? What will be y in that case? Y will be equal to 3 times of that. That's equal to 112.5. So therefore, the number of shares that can be bought back will be 37.5 nominal value divided by 10 rupees per share. You can buy back 3.37 crore, 3.75 crore shares. So forming the equation is very, very important. Once equation is formed, doing it is easy. I'm sure all of you know how to solve simultaneous equations. So forming these two equations, very, very, very important. 150 crore available, X will be transferred to CRR. So only balance can be used for buyback. So assume X to be CRR, Y to be buyback. So the formula 150 minus X is equal to Y, equation number 1. Y can be written like this also, nominal value plus premium, that is 3x. So now we have two equations in x and y. We can solve it like this. So x is 37.5 crores. The amount to be transferred to CRR is 37.5 crores. One share, 10 rupees face value. Therefore, you can buy back 3.75 crore shares only. You cannot buy back 8.25 as per share outstanding test. You cannot buy back 6.25 crore shares as per resources test. So if the loan fund is 1200 crores, yeah, it is possible to buy back 3.75 crore shares. So this is the maximum permissible buyback based on the info given in the question. So what will be the amount of buyback? It will be 112.5 crores. 37.5 nominal value, premium 75. So total buyback will be 112. That is equal to Y. So friends, are you clear? Please tell me, friends, you have any questions? We have completed the problem. That's all. I found out based on the 3 tests, I found out that the maximum permitted buyback is only 3.75 crore shares. Beyond this, even one share cannot be bought back because that will go against the provisions of Companies Act. Okay, I don't find anybody putting any question. So now let us go to the journal entries. That's all. So if the loan fund is 1200 crores, what is the maximum permissible buyback? It will be 3.75 crore shares. So what is the journal entry for buyback of 3.75 crore shares? Very simple. Equity capital debit, premium buyback debit to equity share buyback being amount due to shareholders on buyback. So capital account debit will be how much? 37.5, premium 75, buyback 112.5. So this is X, this is 2X, that is equal to Y. Next entry, premium on buyback should be utilized out of security premium. Whether that much is available? Yeah, that is available. Premium is available up to 90 crores. We can make use of 75 crores now. So debit security premium, credit premium on buyback 75 crores. Nominal value of shares bought back should be transferred from free reserve to CRR. That is 37.5. Free reserves utilized, transferred to CRR 37.5. Therefore, finally, the payment for buyback. Equity share buyback account debit to bank account 112.5. So these are the journal entries you have to make for 3.75 crore shares bought back. Now, friends, you might be interested in knowing whether we have done the problem correctly. Because the condition is what? After buyback, the debt equity ratio should be 2 or less than that. We have decided to buy back 3.75 crore shares. We have done that also. But we have to verify whether the debt equity ratio is 2 or less than 2 after buyback. Do you think it will be 2? Please see the verification part. Of course, this verification part is only for academic interest. Just to check for ourselves that we got it right. See whether you're able to understand this. So after buyback, what will be the shareholders' funds? Paid up capital will become 330 minus 37.5, 292.5, correct? Because you're debiting capital with 37.5. Reserve out of 240, 37.5 goes to CRR. So it becomes 202.5. Premium out of 90, 75 utilized 15. P&L nothing utilized 90. So what is the shareholders funds after buyback? 600 crores. What's the loan fund? 1200 crores. So the debt by equity is exactly 2. It's not more than 2. It is exactly 2. That means buyback of 3.75 crore shares is perfect. So the verification, as I told you, just for our academic interest. No need to do this in the exam. No need to show this in the exam. But for your interest, you can check that you have done this correctly. So friend, that is why I told you this is a very, very good problem, important problem. If it comes in exam, yes, definitely you are going to get around 10 marks. Easily 10 marks can be given for this problem. It has appeared in few exams also. Since it's a very interesting problem, also difficult problem, paper setters would like to test you on this. So please don't miss this problem. Please practice this problem. Who knows? Same problem may come in the exam and you'll be well off that you practice this problem, you'll be able to do it in the exam. Yes, friends, are you having any doubts as regards the solution to this problem? Are you clear? So as I told you earlier also, I have chosen problems which are of extreme importance in the examination. These are all exam standard problems and very much possible to appear in the examination. That's why I've chosen these problems for the purpose of our class, rapid revision class. Okay. Okay, now we have time to do one more problem. Let us use that time to do problem number 7. In fact, I would request you to do this problem in the classroom itself. I can give you some time, maybe 15 minutes time I can give you. You can attempt this problem, share the answers with me, then I will disclose the correct answer. But very easy problem. Two things you have to do. One is redemption of preference share. The other one is buyback of equity share. Number of shares to be bought back is given in the question itself. No need to bother. Whether money is available, yeah, money is also available. So you have to make the journal entry for redemption of preference share, buyback of equity share, and then you have to show the balance sheet. 15 minutes time you can take. Assume it is appeared in the exam. You are going to do it in the exam. Please start now. Share the answer with me, friends. 15 minutes. Let us fix from now. Okay? I'll be waiting for your answers. So friends, as you can see, I am showing the answer for this problem. First, I made entries for redemption of preference share. Very simple, right? First entry, amount due to preference shareholders. Preference capital to preference shareholders. The entire redemption is done out of the free reserve. So transfer revenue reserve to CRR. Huge bank balance is available. So no need to bother. Make payment to preference shareholders. Preference shareholders to bank account. All entries are made on 1st April 2012. So these are the entries for redemption of preference share and then buyback of equity share. Again, very easy, right? All entries are made on 1st April. How many shares are bought back? 50 lakh equity shares. Into 100 will be 500 lakhs or 5 crores. So debit equity capital 5 crore. Premium is 20 crores. 40 rupees per share. So 5 crore shares into 40 is how much? 20 crores. 50 per share. Total amount payable is 25 crores. 50 lakh shares of 25 each. That is 25 crores. Premium is taken from security premium. 5 crore of buyback nominal value taken from free reserve transfer to CRR. And then finally the payment made to shareholders, equity share buyback to bank, 25 crores. ₹50 lakh shares at the rate of rupees 25. How much? At the rate of rupees 50. That's equal to how much? 2,500 lakhs. That's equal to rupees 25 crores. In that, nominal value or face value will be how much? Rupees 5 crores. Premium will be rupees 20 crores. So now after making all these journal entries, we have to prepare the balance sheet along with notes. Share capital, note number 1. Authorized what is authorized capital? 100 crores given in the question. Issued, subscribed, paid up. 2 crore shares of 10 each is 20. Therefore, share capital is 20 crores. Earlier it was 25. Now what happened? 5 crores bought back, only 20. What about preference share? It is fully redeemed. It don't appear. Reserve surplus, capital reserve 15. Premium is 25 minus 20, 5. Revenue reserve is 260 was the balance given, 75 for preference share, 5 for buyback, balance 180, CRR will be 80. On redemption of preference share, CRR created is 75, buyback 5, total 80. Therefore, after all the adjustment, reserve surplus is 280 crores. There is no balance in share application, money pending allotment. There is no non-current liability. Current liability, there is no change. Therefore, balance sheet total is 340 crores. Property, plant and equipment nil, but better prepare a note. Cost is 100, depreciation 100, balance nil. Current asset will be 240. How? 340 given in the balance sheet, 75 paid for preference share, 25 for buyback. So balance is 240. So after redemption of preference share and buyback of equity share, the balance is 240 crores. Sorry, 340. The balance is 240 crores. And of course, we have non-current investment 100. There is no change in that. Market value is more than the cost. So the investment will be shown at cost only 100 crores. So such an easy problem, friends. 8 marks can be given just because there are 7 journal entries and 1 balance sheet. Otherwise, there is no complication in this problem. Actually, it is a very, very easy problem. But still, it will take around 10-15 minutes to solve it and to present it nicely in the exam. That's why they'll give you 8 marks or 10 marks in the exam. I know some of you got the answer, particularly Pooja gave the answer long back. Aditya finished, but his answer was 300 crores. It's not right. Aditya, you can check. Your balance sheet total should be 340 crores. You can't deduct current liability from current asset and show in the balance sheet. In the problem, it is given like that. I know, but in the answer, you have to present it properly in the Schedule 3 format only. Therefore, balance sheet total is 340 crores, not 300 crores. Hope Aditya got it right? Yes, friends, I have completed the solution for this problem. So today, we have completed ESOP and buyback. Sunday, we completed partnership account. So 3 chapters we have completed. And almost 14 plus 4, 18 problems you have done. 18 problems you have done covering 3 chapters. Like that, we will be covering many more chapters. After this, I think we will be taking up liquidation of companies. And probably in that order, I will take the other chapters also. Finally, I will do accounting standards for you, friends. Tomorrow, I will try to do liquidation of companies. Later, I will take up accounting standards. After that, we will do amalgamation and absorption, consolidation we will do. Finally, only I will take banking companies and NBFC because these are the least important chapters, particularly NBFC may or may not come at all in the exam. So I don't want to waste time on that. So if there is no time, I will not do NBFC. Banking company, I will see, but definitely I will do liquidation, amalgamation, consolidation, accounting standard in the remaining 5 classes are there after this class. In those 5 classes, I will try to cover these chapters and as many problems as possible. So friends, please tell me, you have any questions? For premium on buyback, Monish, I'm answering your question. For premium on buyback, always utilize security premium first. If there is no balance in security premium, then you can use revenue reserve. So our premium on buyback, first apply securities premium. For the nominal value of buyback, use revenue reserve only. You cannot do security premium. So therefore, you should not use premium before revenue reserve for the purpose of buyback. Yes, friends, I think today we should say goodbye, even though it is 4 minutes before time. There's no point. I cannot start a problem now and finish it off today itself. So tomorrow, 10 o'clock, we will join for another session of Rapid Revision class. Let me say goodbye to all of you. Thank you so much for listening. We'll meet tomorrow. All the best.